Okay, let's get right into it. We're talking trillions of dollars pouring into artificial intelligence, fueling a revolution that is changing, well, pretty much everything. But all this cash, this absolute tidal wave of money, has everybody asking the same giant question. Is this real, sustainable growth? Or are we all just riding a massive bubble that's about to pop? So, here's how we're going to break it down. First, we'll follow the money and map out the trillion-dollar AI loop. Then, we'll see if we're getting some serious flashbacks to the dot-com crash. After that, we'll explore why this time might actually be different. We'll check in on Wall Street's verdict, and we'll wrap up with a checklist, what you need to watch for.
All right, first up, we need to untangle this incredibly complex web of relationships at the very heart of the AI boom. And let me tell you, it's a web of deals that is raising a lot of eyebrows. At the center of this whole debate is a term that you are hearing more and more: circular financing. But what does that actually mean when we're talking about AI? Okay, think of it like this. Company A, a tech giant, invests $1 billion in Company B, a hot AI startup. What does Company B do? It turns right around and uses that exact same money to buy $1 billion worth of products from Company A. It's a closed loop. The money goes out as an investment and comes right back in as revenue, creating this powerful, self-reinforcing cycle that can make demand look way, way bigger than it really is.
And here you can see this loop playing out in the real world. You've got Nvidia investing in AI startups like OpenAI. Then OpenAI turns around and buys a mountain of chips from, you guessed it, Nvidia. At the same time, OpenAI commits to spending billions on cloud services from Microsoft and Oracle. And what do Microsoft and Oracle have to do to provide those services? They have to buy billions of dollars worth of chips from Nvidia. It's this perfect high-stakes circle where investment, spending, and revenue are all completely tangled up. The scale here is just mind-boggling. OpenAI alone has committed to spending over $1 trillion on chips and cloud infrastructure. Now get this, its projected revenue is just a tiny, tiny fraction of that number. And it's this massive gap between spending commitments and actual earnings that has analysts waving some serious red flags. This whole circular thing is giving analysts a major case of déjà vu. It's drawing some direct and, frankly, pretty uncomfortable comparisons to the big one, the tech bubble of the late 1990s. The parallel is, well, it's kind of spooky. Back in the 90s, you had this thing called vendor financing. A company like Lucent would basically loan money to its own customers, who would then immediately use that loan to buy Lucent's gear. It was a way to just print revenue out of thin air. And that house of cards came crashing down spectacularly. The fear, of course, is that today's circular deals are just a shiny new version of the exact same trick. You know, Paul Graham from Y Combinator said it best about that era. You had this crazy feedback loop. Investors funded startups, those startups spent the money on ads with Yahoo, which made Yahoo's numbers look amazing, which then convinced more investors to pile in. And that raises the trillion-dollar question for today. Is the revenue we're seeing real, organic customer demand, or is it just recycled investment cash going around in circles? And here's another echo from the past: insane market concentration. Right now, the entire U.S. stock market is basically being held up by a handful of AI titans. Just 5 companies make up nearly a third of the value of the S&P 500. That is a classic risk factor, because if even one of those giants starts to wobble, it could drag the whole market down with it. Okay, so that's the scary part. But let's flip the coin. For every skeptic screaming bubble, there's a true believer saying, no way, this is not 1999 all over again. Let's look at why this time could be fundamentally different. And this quote from venture capitalist Byron Dieter, it perfectly captures that bullish argument. The idea is that the dot-com era was built on hope and hype, pure speculation. But today's AI leaders, they're built on real-world demand and rock-solid financials. And this chart really lays out the core differences. Remember all those dot-com companies with zero profits just burning through cash? Today's AI giants are absolute cash-generating machines, funding this revolution with profits from their core businesses. And that glut of dark, unused fiber optic cable that basically defined the dot-com bust? We have the exact opposite problem today. Demand for AI chips and data centers is literally outstripping supply. And you can see that demand in where the money's flowing. A mind-blowing 70% of all venture capital money this year is going into AI. The argument isn't that investors are just chasing a buzzword. It's that the capital is being anchored to real, physical things, the actual chips, the servers, the data centers that are the bedrock of this whole revolution. So, we've got really strong arguments on both sides. The big question is, what's the consensus from the people whose job it is to figure this stuff out every single day on Wall Street? So what is the verdict? Well, surprisingly, there's a pretty strong consensus. Top analysts from firms like Goldman Sachs and JP Morgan are largely in agreement. They're saying that while valuations are definitely sky high, and yeah, those circular deals are a concern, we are not in a bubble. But here are the two most important words they add: not yet. And that not yet is doing a whole lot of work because they're pointing to some classic bubble indicators that are starting to flash yellow. Big tech is taking on more and more debt to fund its AI ambitions. The IPO market is getting really frothy. New AI stocks are jumping an average of 30% on day one. And there is a massive and widening gap between the wild valuations of private AI companies and their peers on the public market. So let's get practical here. What are the definitive signs that would tell us this boom is officially turning into a bust? What should you actually be looking for? Well, Acadian Asset Management has this fantastic checklist they call the 4 Horsemen of the Bubble Apocalypse. And they argue a true, full-blown bubble needs all 4 of these things happening at once. First, a massive wave of risky AI companies going public. Second, big companies using their own inflated stock as monopoly money to buy up other companies. Third, the tech giants suddenly stopping their stock buybacks. And fourth, a full-on retail frenzy where everyday investors are just blindly pouring money in based on hype. And here's the key takeaway. Right now, we are just not seeing all those conditions line up. But this brings us to the final and maybe the most critical piece of the entire puzzle. With all this money being spent, is AI actually, working? Well, a recent MIT study delivered a really sobering statistic. A staggering 95% of corporate AI projects are currently failing to deliver a real return on their investment. The hype is there, but for most, the results just aren't yet. Which leaves us with the ultimate question, the one that will define this whole era. Will generative AI actually create enough tangible, real-world value for businesses and for all of us to justify the trillions and trillions of dollars being bet on its future? Because the answer to that question is going to determine whether this is a true technological revolution or the biggest financial reckoning we've seen in a generation.